Ask rates for IT companies to meet consensus growth expectations in the second half are too aggressive. Reema is here with more details. Reema, over to you.
Thanks so much for that. So basically, what does an ask rate mean? Now, the street has certain expectations in terms of a growth rate that IT companies will achieve in FY25. It could be a 7% growth, 8%, 9% growth. So what do the companies need to deliver on a quarterly basis? So say a 2% growth in Q1, 2% growth in Q2. So that's the ask rate, CQGR, a compounded quarterly growth rate. So that, according to Ambit, is still on the higher side. And remember, earnings estimates for IT companies have been brought down post the Q2 miss. But still, according to Ambit, consensus expectations are too high. What the companies need to deliver on a quarterly basis for top-tier IT companies like TCS is at 2.9%, Infosys at 3.3%, Wipro is at 1.8%, Tech Mahindra is at 2.6%. That, according to Ambit, is the highest that we've seen in the last 6 years, X of the COVID year, 2022, which got boosted due to pent-up demand. For hcltech, Ambit says the ask rate, which means how much the company needs to deliver to achieve its consensus expectations for FY25, appears to be reasonable because the company needs to do about a 1.9% growth every quarter in FY25. Now, for mid-cap IT companies, or Tier 2, as they call it, they're saying the ask rate is 2.7 to 3.9%, and this is in line or above the 5-year average. Expectations for LTI, Mindtree, Coforge, and Persistent are at the higher end of this range, and they appear most at risk. Also, Ambit goes on to talk about the valuation. Valuations for large caps are at a 36% premium, and mid caps are at a 100% premium to their pre-COVID average valuation multiple. So they're saying that even after the misses that we've had on the earnings front for 3 consecutive quarters now, Q4, Q1, and Q2 of FY24, valuations are still on the higher side, and consensus expectations still appear to be a bit aggressive by the street. Back to you.
Okay, all right, Reema. Well,